Well, stock futures are gaining this morning, continuing the rally fueled by cooler than expected inflation data and bets on a less hawkish Fed. Big tech companies gave the S&P 500 its biggest boost. But can the rally continue? And can we sustain disinflation without recession? Here with us now is Lee Ferridge, head of macro strategy for North America at State Street. That's the key question you brought up just a few minutes ago. Can we continue to see disinflation without recession? Or conversely, without these companies that we've been talking about, if they're still holding the line on prices or even raising prices, we're not going to see this disinflation. Can we?
No, I think it's very difficult. There's a number of factors here. Wage inflation I mentioned before is a key element to this, and I'm looking at this earnings season to see where we are on that and what companies are saying. But there's also the thing that the inflation genie is out of the bottle in some ways. So it's very hard for companies to raise prices in the sort of post-GFC to 2020 period because prices just didn't go up anywhere. So very hard to pass price increases on. That's changed. Almost now people are accepting of higher prices. They don't like it, but we've got used to it. And so that genie is out of the bottle and you almost have to put it back in. And the only way you really do that is actually by slowing the economy quite strongly.
And so we had heard this term yesterday, a growth recession. What in reality does that look like on the other side if we do see a growth recession? And perhaps we can kind of put some terminology around that to kind of educate not just myself, but a few other viewers out there.
Yeah, I'd love to know as well. I don't know what a growth recession is. I think this is the latest sort of the balls of transition from soft landing to maybe a growth recession. This is the latest sort of narrative to justify valuations and where we are. Is we can't say outright recession. We can't say the economy is going to contract. So we'll go soft landing. Oh, maybe not soft landing. Let's go growth recession. I don't know what it is. I'll be absolutely honest with you.
Are we going to see a recession, at some point? And when is it now going to happen?
We are going to see a recession. I honestly believe that. And I think it's more likely a story for the second half of next year.
So if that's the case, and the only thing that will really put the inflation genie back in the bottle is a recession, is the market vastly underestimating the number of Fed rate hikes that are to come? Will the Fed be more persistent than we're expecting?
I think after the number yesterday, look, they're going to hike this month. I still think there's a bigger chance than the market thinks that we get at least one more hike, because I'm not going to overreact to 1 month of data. I'm looking at the labour market. I'm looking at average hourly earnings. 3-month annualized average hourly earnings of 4.8%. It's the highest reading this year, right? So payrolls has slowed a bit, but we're still running about 250,000 3-month average. That's way above where it needs to be. So real earnings are now positive. We're hearing about the strength of the consumer. All of this means the economy keeps going, means you have this shortage of workers, means you have this wage pressure, and we hear companies will pass this on. So yes, you'll get some disinflation, and we're seeing that. But where does the disinflation stop? Where do we bottom out? This is going to be the key thing. I think we bottom out on core maybe 3.5%, 4%. That's not 2, right? So the Fed could, they'll go in July, they'll have a look at the data, and maybe they won't go in September, maybe it's November. But the big thing the market is getting wrong is we have about 100, 150, 125 basis points of cuts in for next year. That's not coming. That's going to be the higher for longer is where we really need to rethink this. So even if we go into recession next year, as I predict in the second half of next year, if core inflation is still above 3, what does the Fed do? They can't cut rates. If you're serious about a 2% inflation target, you can't just jump in and cut rates when inflation's above 3%. And that's why I said before, I think you're going to see a recession that's not catastrophic, not deep like we saw, post GFC or even the very short-lived pandemic one, but one that could go along for a while because rates don't come down sharply as people think.
What is the risk of us, or the ramification of having talked about a recession for the better part of the last year plus, and then not actually seeing one until, if your projection reigns true, next year?
People get overconfident. And then we see valuations like we're seeing now, and we see people start to talk about a growth recession or a soft landing. We sort of, you get confident because you can say, People said there'd be a recession in 2023. There wasn't one. There's not going to be one at all now. No, it's just later. Look, there's a number of factors why the recession didn't happen straight away. The shortage of workers, so the labour market's still strong. Excess savings from the pandemic, they're still there. I estimate about 1.2 trillion in excess savings from the time of the pandemic. And the third thing is, in the US, and this is unique to the US, higher rates are not hurting the majority of people. If you look at mortgage payments as a percentage of disposable income, they are lower today than they were in January 2020, even with 500 basis points of rate hikes, because during the pandemic, people refied, they locked in for 30 years, and so as rates have gone up, mortgage payments haven't changed. That's not true in Europe, that's not true in the UK, that's not true in Canada or Australia, where you have variable rate mortgages or short-term fixed rate mortgages. There you're seeing the recession come through. Eurozone is virtually in recession. The UK is virtually in recession. You know, it's very close. Here it's taking longer because you have around 90% of mortgages are 30-year fixed. It's not hurting most people.
So let's bring it all back to the markets, everything you've been saying. You've mentioned valuations a couple of times. If I'm an investor, do I avoid stocks here? Do I get in here? Where's the S&P 500 going to go in the next 6 months?
Look, I have a reputation for being a bit bearish. I mean, I'm English, I'm an economist, I live in Boston. I mean, you know, I'd be wary at these levels. I'll be absolutely honest. I'm wary at these levels. I think the market is priced for, as you say, you know, this growth recession or this soft landing. That's the narrative now. That's what the market's priced for. And at the same time, we're pricing in 125 basis points of cuts next year. Well, why are the Fed going to be cutting so aggressively unless we're in a recession? The two don't add up. You know, the bond market is saying one thing and the interest rate market is saying one thing. The equity market is saying another. And this is where I think that this sort of, I worry about equity valuations. I think we have this sort of perfection. You know, the AI boom sort of dragged everything up, and now we've got the sort of signs of inflation coming down or slowing more. And all of that is sort of fueling this narrative. It makes me nervous. It makes me nervous from here. Look, I think during the next few weeks in the earnings season, we're probably going to see more gains. Beyond that, I do start to worry.
Lee, it has been so much fun to talk to you. Even with the bearishness and the Bostonness and the English, it's all of that has been a pleasure. Lee Ferridge, thank you so much. Really appreciate it.
Thank you very much for having me.
Lee is head of macro strategy of North America at State Street.